Let me ask you something. What if you found out that one decision, just one, could cost you over $100,000 in retirement income? Not because of a bad investment, not because of a market crash, but because of a choice you made about Social Security that seemed perfectly reasonable at the time. That's exactly what happens to thousands of retirees every single year. And the heartbreaking part, most of them don't find out until it's too late to do anything about it. I'm going to walk you through 5 Social Security mistakes that can silently drain a 6-figure sum from your retirement, and more importantly, what you can do to avoid them. Stay with me, because even one of these could change your financial picture dramatically. Let's start with the biggest one: claiming Social Security too early. The earliest you can claim Social Security is age 62. And I completely understand the appeal. You've been paying into this system your entire working life. The money is right there. Why wait? Here's why. When you claim before your full retirement age, or FRA, which is 67 for most people watching this video, your benefit is permanently reduced. We're not talking about a small dip. We're talking about a reduction of up to 30%. That reduction doesn't go away after a few years. It stays with you for the rest of your life. Let me put some real numbers to this so that it sinks in. Say your full retirement age benefit is $2,500 a month. If you claim at 62, that benefit gets reduced to approximately $1,750 a month. That's a $750 monthly difference. Now let's do the math over a 20-year retirement. That $750 per month adds up to $9,000 a year. Over 20 years, you've left $180,000 on the table. And that's before we even factor in cost of living adjustments. Now I know what some of you are thinking, but what if I die young? Won't I lose out by waiting? That's a fair question, and it's one we can look at specifically for your situation. But for the average person who makes it to their mid-60s in reasonable health, the math almost always favors patience. The other thing to understand is that this decision is largely permanent. Once you claim, you have a very limited window to undo it. And after that, you're locked in. Now, let's talk about something that doesn't get nearly enough attention. And it may be the most expensive mistake married couples make. Most couples approach Social Security as two separate decisions. Each spouse looks at their own benefit and decides when to claim based on their own situation. What they don't realize is that these two decisions are deeply connected, and getting it wrong can devastate the surviving spouse. Here's how it works. When one spouse passes away, the surviving spouse doesn't get to collect both benefits. They keep only the higher of the two, which means the higher earner's benefit essentially becomes a life insurance policy for the surviving spouse. So here's a scenario I see all the time. Both spouses claim early at 62 to get the money coming in sooner. The higher earner locks in a permanently reduced benefit. Then, years later, one spouse passes away. The surviving spouse, often a wife who statistically tends to outlive her husband, is now living on that reduced benefit for the rest of her life. Let's put numbers to it again. If the higher earner's full retirement age benefit was $2,800 a month and they claimed at 62, that survivor benefit might be closer to $1,960. If they had waited to age 70, that benefit could have grown to over $3,400 a month. The difference to the surviving spouse? Nearly $1,500 per month. Over 10 years of widowhood, that's $180,000. The widow or widower financial crisis in this country is real, and a significant part of it is rooted in uncoordinated Social Security decisions made decades earlier. The strategy here is intentional coordination. In many cases, the lower earner claims earlier while the higher earner delays as long as possible, ideally to age 70, to maximize that lifetime survivor benefit. Here's one that catches people completely off guard. You decide to claim Social Security at 62 or 63, but you're still working, maybe part-time, maybe full-time, and you assume you can collect your benefit and your paycheck at the same time without any issues. Not so fast. If you claim Social Security before your full retirement age and you're still earning income, the Social Security earnings test kicks in. For 2026, if you earn more than $24,480, Social Security will withhold $1 in benefits for every $2 you earn above that limit. If you'll reach full retirement age in 2026, the limit is $65,160. After that, Social Security will withhold $1 in benefits for every $3 you earn above that limit. For a lot of people, that means their Social Security checks slow down significantly or stop altogether, and they have no idea why. Now, I want to be fair here. The withheld benefits aren't completely gone forever. When you reach your full retirement age, Social Security recalculates your benefit to give you some credit for those withheld months. But it takes years to recover what was withheld. The timing disruption can throw your whole retirement income plan into chaos. And many people in this situation feel blindsided because nobody explained this to them in advance. The lesson is simple. If you plan to keep working, be very careful about when you claim. Claiming early while working can create a frustrating situation where you're earning income but not collecting the benefit you expected, and you've permanently reduced your future monthly payment in the process. I want to spend a little extra time on this one because it surprises almost everyone I talk to. Your Social Security benefit may be taxable. In fact, up to 85 cents of every dollar you receive from Social Security can be subject to federal income tax. Most people hear Social Security and assume it's tax-free retirement income. It's not, at least not automatically. Whether your benefit gets taxed and how much of it gets taxed depends on something called your provisional income. Here's how that's calculated in plain English. You take your adjusted gross income, that's things like withdrawals from your traditional IRA or 401k, pension income, interest, dividends, and you add that to any tax-exempt interest, like from municipal bonds. Then you add in 50% of your annual Social Security benefit. That total is your provisional income. If that number exceeds $34,000 for a single person or $44,000 for a married couple, up to 85% of your Social Security benefit becomes taxable income. Now, here's where it gets really painful. When more of your Social Security gets taxed, your total income goes up. And when your income goes up, it can trigger something called IRMA, Income Related Monthly Adjustment Amount, which causes your Medicare Part B and Part D premiums to spike. So one problem creates another. The good news is this is a solvable problem, but only if you plan ahead. Strategic Roth conversions before you claim Social Security, being thoughtful about which accounts you pull from in retirement, and understanding how your income sources interact can dramatically reduce or even eliminate the unnecessary taxation of your Social Security benefit. This last one is the simplest mistake on the list, and it might be the easiest to fix. Your Social Security benefit is calculated based on your 35 highest earning years. If you have fewer than 35 years of work on record, Social Security fills in the missing years with zeros. Zeros drag your average down, which reduces your monthly benefit. On top of that, errors happen. Wages can be misreported. A job from 20 years ago may show incorrect earnings. Most people never check, so the error just sits there, quietly reducing their future benefit. The fix is simple. Go to ssa.gov and create a My Social Security account if you don't already have one. Review your earnings record once a year. Make sure every year of work is reflected accurately. If you see an error, you can work to get it corrected before you ever file a claim. One correction to your earnings record could mean hundreds of dollars more per month, every month for the rest of your life. That's a phone call or a few minutes online that is absolutely worth your time. Let's bring it all together. 5 Social Security decisions that can cost you $100,000 or more in retirement income. Number 1, claiming too early and locking in a permanent benefit reduction that compounds over decades. Number 2, failing to coordinate spousal and survivor benefits, which can leave a surviving spouse living on far less than they should. Number 3, claiming while still working without understanding the earnings test and what it does to your checks. Number 4, ignoring the tax exposure on your Social Security benefit and letting unnecessary taxation quietly erode your income. And number 5, never reviewing your Social Security statement and leaving earnings errors uncorrected for years. Now here's what I want you to understand. None of these mistakes are inevitable. Every single one of them can be avoided, or at least minimized, with the right planning done at the right time. But here's the important part. The right strategy is not the same for everyone. Your age, your health, your income sources, your spouse's situation, your other assets, all of it matters. A strategy that works beautifully for your neighbor could actually cost you money. Because you made it this far, you might be interested in the free booklet called Maximize Social Security Income. There's a link to a website to grab your copy in the description box below. If this video was helpful, please give it a thumbs up. It helps more people find this information when they need it most. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.